Hi there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I'm here to bring you a brief market summary for the week ending October 25th, 2024. After I do that, I'll move on to looking at some trading levels for some of the major market indexes, as well as we'll take a look at a handful of popular company symbols. Before I get going here, the usual disclaimer, Precision Trading Labs, we are neither money managers nor financial advisors. Nothing here is to be construed as investment advice, and everything is for educational and informational purposes only. Okay, so at any rate, let's take a quick look at the major market indexes here. We're looking at the SPY, which of course is the ETF of the S&P 500, and we're pretty much sitting right off of all-time highs here. We had hit an all-time high here a few days ago. We're about 1% or 1.5% off of that, and so we're sitting right now at around 579. The all-time high here, of course, you can see was at 586. So we're about 7 points off of that. So it's a little more than 1%. So at any rate, that's where we're sitting on the SPY. If we take a look at the Qs, similar situation. We had actually hit the all-time high back here in the end of July, and now we've been sort of knocking on the door here. This region right here is actually more or less kind of almost like a resistance level, and we'll kind of talk about this in a couple of minutes here. But we're sitting right here pretty close to all-time highs on the Qs. And the Qs, of course, are the ETF of the NASDAQ. And lastly, we'll take a look at the IWM, which is the ETF of the Russell 2000. That's actually a very different situation here. We're actually sitting close to a 52-week high here. However, the all-time high on the Russell was actually back in November of 2021. In fact, if we flip back here really quickly here, we can see that right over here is the all-time high right here in November, right there. Okay, so the all-time high on the Russell is about 244.5, and so in terms of the distance where we are from that, that's actually pretty considerable here. We are in the right now. We're sitting basically about a little over 15% off of that. So that's definitely the kind of the laggard there. So at any rate, that's the story with the Russell. Before I get into some trading levels here, what I want to do is I'm going to show you a recent trade that we actually did with General Motors right after it announced earnings a few days ago. And in fact, we're actually in the midst of this trade here. And it's a good illustration of the foundation of what's behind our trades here at Precision Trading Labs. So let's take a quick look at that. And that'll actually give us some insight, though, when I start to show you levels on the market indexes and then that handful of company stocks that I had mentioned. So at any rate, right here, this is a level that we had seen. And in fact, right here, we had actually done a straddle. Okay. And so this was a straddle that we had actually done on October 21st. Okay. And in fact, then we had gotten in here, we had put on the straddle, and we actually got out here. It was actually kind of a nice trade. But the important thing here is actually what was in the chart on February of 2022. So this is actually about a little over 2.5 years ago. Okay, and this is what I want to talk about here. And so this inset here, this is essentially that level here. So okay, so and again, that's from February of 2022. So we take a kind of zoom in on that. Here's what we were just looking at there. So right there, that's February 1st or July 31st or January 31st, 2022. And what we're looking at here is price. We're looking at a daily chart here. And so price rallied up here, and then essentially then right here, it more or less peaked, kind of a pivot here. And then notice that very, very bearish candle that comes out of there. Okay, so even though it's a green candle, okay, it's obviously a very bearish candle because it came up here and then kind of gave almost everything back there. And then, of course, we have a gap, and then price kind of descends from there. And if we think about what went on in this level, and particularly if we had actually looked at this in a 2-hour chart, we would see a clear consolidation in here. And so if we think about the shares that are acquired by sellers, we can think of that as the demand for shares, okay? And if we think about the shares that are offered up by sellers, we can think of that as the supply of shares, okay? And so within this region here, supply and demand were in balance, Okay. And then right here, we essentially had an exhaustion of buyers. No one was willing to buy anymore. Okay. And so right here, again, where we had supply and demand that was in balance in here. Okay. Once there is no one's willing to buy anymore, essentially there is no longer any demand at this level. Okay, and what's left in its wake and then is only supply, and hence we refer to this as a supply zone. Okay, and if it meets certain criteria in terms of the structure of the candles and in terms of how price leaves it, in terms of its energy and its distance, if it meets certain qualifications, um, a supply zone is then where we look to then express a bearish trade if and when price returns to it. Okay, so right here, this is not a trade unto itself. We would never be trading the breakout here. But what we're looking for is when price returns back to this supply zone, this is where we would express a bearish trade. Okay, and of course, expressing a bearish trade, of course, one could short the stock. Okay, and we're looking at GM here, so one could short GM. But another way, of course, one could express a bearish trade would be to buy a put. And of course, if one wanted to collect premium, one could also express the trade up there by doing a bear call vertical credit spread. Those are all ways of expressing a bearish trade, but they would all be based on this supply zone, on that supply zone here. So that's the basis for our trades, okay? And so if we look over here, okay, we had actually looked here. This was the level, the foundation for the trade. And then once um, General Motors had finished its run from its earnings announcement, we then kept an eye on it the next day on the 23rd. Okay, so we got into this trade here on the 21st. Okay, we closed out the straddle on the 22nd. Okay. Then the next day we got into this put trade. Okay. And so we ended up buying the January 17th, 2025 put. The expiration was 57.50. So we basically bought it, I guess 2 strikes in the money. Because right here, this is incremented in 250s. So we were running a delta of about 65 or 70, I believe. And so that was the foundation of this trade here. So price came up, rallied here, and now it's on its way down. Okay, so we got into this at 505, and this is now sitting at a roughly about 610 or so. So we're actually up about what is that? Roughly about 20%. We're up about $1 on this. So what we're of course looking for is for this thing to descend further, and we're looking for it probably to, let's say, get down to roughly that 48 level or so, and then we would probably be looking to close that out at that point then. Okay, but anyway, so that's the foundation of our trade. Leaving the options aside here, this would be our entry price, no matter how we decided to express the trade. Again, either by shorting stock, buying a put, or doing a credit spread. Okay. Okay, so each one of these rungs of this ladder here essentially represents one unit of risk. Okay, so here's our entry. If the trade didn't work out the way we would like, okay, this is where we would essentially admit defeat and just say, okay, this is our stop out point. Because essentially right here this is our supply zone here, okay? And so right there's the supply zone running from 53.70 up to 55.55, okay? And then we just place the stop a bit behind that zone, okay? And so generally, what we do is once we have the zone here, and then we'll give it an extra 15 or 20 cents, and we'll use a lot of times. If you notice right here, we have the average true range here, and that's sitting at $1.56. I tend to like to give it an extra 10% of its average true range when it makes sense. Okay, so that's where that extra 15 cents came from. Over 55.55, that 55.70, that's based on that 10% of the ATR. That's where that extra 15 cents came from. Okay, as of course we can see, didn't really need it here, at least at this point. So price rallied, dropped out of here. And so we're close to that 1-to-1 mark in terms of the underlying. Okay. And again, what we'd be looking for is for price to come down here. And then, we would evaluate this down here. And then right here, this is an area where we would expect that this congestion area here might kind of sort of put the brakes on the drop here. But meanwhile, that would actually be kind of a nice move here, going from 53.70 to, let's say, 48.50 or so. Okay, that's about four, but that's almost 480. They'll call it almost a $5 drop. And so if we're running a delta of, let's say, 70 or 80, that we'd be looking probably to be making that $4 on this option. So that would actually be kind of a nice trade here. So we'll see how that pans out. But again, that's the foundation for our trade. Down here, okay, I showed you a supply zone here. This down here is a demand zone. Okay, it's the same narrative, of course, but inverted. So right here, price came up. Notice then price consolidated here. Again, supply and demand were in balance. Okay, again, the shares that are acquired by buyers and the shares that are offered by sellers, they all they all essentially get shuffled back and forth within this relatively narrow range. And then right here, we have an exhaustion of sellers. Okay, up here we had an exhaustion of buyers. Down here we have an exhaustion of sellers. And now notice that price popped here a little, and then notice that substantial gap here. And then obviously it runs from here. So right here, here's where we would be looking to express a bullish trade. Okay, but of course we would need to see a pullback all the way back to here. Okay, but that's kind of a prime demand zone that's sitting there. Okay, so that's the foundation for our trades. Okay, so now if we actually go back to the live charts here, we'll take a look at that. And now that you have that idea here, we can now look at some supply and demand zones for the market indexes, as well as for that a handful of popular company symbols here. All right. So here's the SPY here. I'm going to spread this out a bit here. Okay. So right here, okay, here's an example of a demand zone that's already been hit. Okay. Price rallied. Notice that consolidation here. We have that engulfing candle. We have that spinning top. And then notice those two very, very bullish candles along with that gap here. Okay. So this was a clear area of demand. Price came into here and we actually got a bounce out of there. And I think some of our subscribers, we actually had a kind of a small trade here. Kind of rode this for 3 or 4 points. Some people, bought short duration, bought calls, held them for a day or two, and then sold them out at the end of the week here. So this is now spent demand. This is tested demand. When price comes back here again, particularly because this thing is that this wick essentially penetrated the entire thing here, this is no longer a trade. Okay, this is a used up demand zone here. Okay, so at that point, then the next demand zone that's down here is here, and you may look at this and you go, well, I don't really see any kind of clear demand here or consolidation, and that's because it really kind of shows up better using a different lens. And the lens here is, rather than looking at it in the daily, we're actually going to look at it in a 2-hour chart here. Okay, so if I change this over here, right here, okay, here's that area that I just showed you here. And then right here, if we look here, notice price comes up, consolidates. Okay, we have that relatively bullish candle. Then notice again that kind of that spinning top of a red candle, and then notice then there's that pop right there. Okay, and then there's a pause here for about a day, and then it kind of keeps going there. Okay, so this is where we would express, though, a bullish trade here. Again, supply and demand were in balance. Right here is where we have the exhaustion of sellers. Okay, and so now we're waiting for price to return to this level in order to essentially tap the kind of upward price pressure that we still expect to see when price returns to this region here. Okay, and so that region right here, in terms of where it is, it's actually a short distance down here. This is where we close at 579. That's sitting roughly at about 572. So in terms of its distance, it's about 1.2% down. So in the coming week, if we have a down day, let's say a couple of down days, or even one down day, if it happens to be somewhat substantial, we could very easily pull back here, and then that would be our that would be the predicate for a bullish trade. But in the bigger picture, though, we're in an uptrend here, so that would be just kind of a pullback in the context of a bigger picture uptrend. So that's the SPY. We take a look at the triple Qs. Just waiting for that to come up here. Okay, there we go. And let me actually go back to the daily chart here. So right here, there was a 1 hour there was a 1 hour demand zone here when price pulled back, and then we kind of got that bounce here. So again, this is now a tested demand zone. So for us, there's no trade now because we've already used it up. It's not to say that demand or supply zones don't work a second or even the third time, but there's an expression: the first test is best, because when price returns here, the second or third time, it may have just chewed up everything that was in there. And so as a result, we're generally looking for fresh demand zones that have not been touched. So right here would be an example of a demand zone that has not been touched here. Okay. And so right here, price popped here. And so we would be looking for, again, right here is where we had consolidation, supply and demand were in balance. And then right here, there was that exhaustion of sellers here. And so as a result, essentially price buyers essentially had to run up the price chart until they encountered willing sellers, and that's how these candles then subsequently formed. So in terms of distance, that's about 4.5% down. So for us, we really don't see a great buying, any really great buying level on the Qs until you get down to until there's about a 4% drop here. Having said that, if there is some subsequent price action, we could in fact get a closer demand zone form. But as where it's sitting right now, there isn't. So for us, there's really no near term. There's no near term trade with the Qs here. We took a look at the IWM here. Okay, so right here, this is where above. So if we look right here, um, this is a supply zone that actually formed in November of 21. Okay, so if we go back here, I show you that. Okay, right here we have a drop, a base, and a drop there. Okay, so right here we have again that exhaustion of buyers that occurred right here. Okay, and so when price is really technically price returned here, right here in August. So about what is that, 3 months or so ago, 2 months ago, it returned right here, and you can see it really just kind of kissed the front level and then immediately kind of dropped like a hot potato there. It's almost like touching a hot stove. Okay. And so technically this is not a fresh level anymore, but in terms of, being practical, it really, and we just kind of blow it up here, you can see that little tiny incursion there. It dipped in there for about 10, maybe about a dime, and it was probably in there for like, 5 minutes, if that much. So for all intents and purposes, this is a fresh supply zone. Consequently, when price returns to the supply zone, this is where we would be looking to express a bearish trade. And so right here, we close at around 219. That level is sitting at about 228 and a half. So that's about that's about 10 points above where we are now. And that's about a 4%, that's about 4% there. Okay. And in terms of how that trade would be structured, um, okay. Obviously, again, one could, let's say, one could buy a put there. One could do with the bear call vertical credit spread. Okay. But in terms of the how one would structure the trade, okay, our entry would be right down here. I got to worry about getting an exact, but technically at 228.54. Again, the average true range on this is $3, so I would give this an extra 30 cents or so. So the back line of the supply zone there is 233. So I would put the stop out point roughly about there. So essentially, that's what our trade would look like. That would be a 1-to-1 trade. That's a 2-to-1 trade. That's a 3-to-1 trade. Okay. And one of the things we also look for when we construct our trades is we look to see where there might be an opposing zone. Okay. So when price comes up here, at least as of this point, the nearest opposing zone is right down here. If we look at this in a 2-hour chart, we would see that this is a 2-hour demand zone down here. So that's sitting at around 212. Okay, so if we got into 228, we could be looking for, don't necessarily expect to get that entire move, but if it starts to head down, there really isn't any clean, fresh demand until you get down to here. Okay, right over here though, if we just take a really quick look here, okay, right there, there's a price dipped in there, returned here once. I wouldn't even really call this as support, okay, but it's quite possible that price might get stopped over here as well. But really, this is the first clean demand zone where we would be looking to express a bullish trade there. So that's the IWM. If we take a look at Meta, let's move on to some stocks here now. We take a look at Meta. Okay, so right here, here's the all-time high here on Meta here. So that was around just over 600. We're now sitting at around 573. But the closest demand zone here is really down here, about 6% down. So we would need to see about a $36 move down here, and that's about 6%. Okay. Other than that, there's really nothing here that we'd be looking to trade. There's this kind of sloppy consolidation here. Price came down here, bounced here. So if this thing starts down, I wouldn't necessarily expect price to get held up by any of this mess here. But right here, this would be the first place that I would expect that there is that there's some solid demand where there's going to be some upward price pressure that we could catch a bounce there. So that's Meta. Taking a look at Apple. Okay. Again, we're near the all-time high here. That was sitting at around 237. We're now sitting at around 231. So we're about 2 or 3% below the all-time high here. Right here, this was actually an area. Also, this is an area of tested supply. Okay. So in other words, price came up here, consolidated, dropped. Okay. There's that exhaustion of buyers here. Okay. So this was an area of supply. Notice price came back here, and let me just blow this up here a little. Notice price then came back, okay, wicked in there, dropped like a stone, came back here, did it again, okay, dropped, came back, did it again. So this is a very, very well tested, uh, of tested supply, and we can also, of course, think of it this at this point as resistance as well. So in terms of what we would be looking for, in fact, if price spiked from here and the market kind of held together, I would expect this region to actually be kind of porous. Okay, so if we approach this all-time high, this would actually be a place where I would expect that one could play a breakout to the upside here, because this is an area that's kind of been chewed up here. So I would not really expect this to really to remain intact in terms of a place where I would express a bearish trade. Okay, so right down here though, this is an area where there's a drop, a base, and a rally here. Okay, right here, this is an area of demand. Okay, and that's actually sitting that's a fair distance down now. That's about 6.5% down. Okay, but that's really the next place that I would be looking for to express a bullish trade here. Okay, right over here in here, this was an area, if we looked at this in the 2-hour chart, there was a rally, a base, and a rally here. Notice price came back and popped from there. At this point, okay, this was a solid demand zone at the time. It's no longer, it's already been used. Okay, so that's already been chewed up. So that's the end of that. Okay, so again, we will be waiting for a pullback there. And that's our trading level on Apple. Taking a look at Amazon. Okay, again, right there, there's your all-time high, just over 200 here. So we're actually sitting, obviously, a bit, a fair amount off of the all-time high here. Okay, that actually created a supply zone up here. Okay, right here, there was a supply zone that got created below here. There was a drop, a base, and a drop there. Okay, notice price consolidated here. We had the exhaustion of sellers. Notice price came back there and then dropped out of here again. Okay, we would not be looking to short from here, but in fact, we would actually potentially be looking to short here. Having said that, it is in the area of an all-time high, and so as a result, one wants to be somewhat cautious about that. So that's the level on Amazon. So that's about 5.5% up here. Okay, and then right down here nearby, about 2.5% below, we have a drop-based rally formation here. Okay, this is an area of demand, and so of course this is where we would express a bullish trade. Okay, having said that, we would probably want to see this thing pop a bit more in order to give us more room for profit here. If it pulls back here, this is probably not going to be a great zone because it really didn't go very far. Okay, so we want to see it at least have this thing pop a bit more so that it doesn't create any supply immediately in front of this. So we'll be keeping an eye on this though. So that's about 2.5% down. If this level would fail though, this would be the next level down here, and that's around 6% down. Okay, and again, just to show you how we would structure this, again, right there, there would be our entry. There would be our okay. There's the back line of our zone here. The average true range here is about 350. So we would probably put this at around 179.90, and then that more or less would be what our trade would look like right there. And again, one could express that trade by either buying a call, or in this case, from a demand zone, one could also, of course, do a bull put vertical credit spread. Okay, so those are all ways, and of course there are numerous other ways one could express that trade using options there. Taking a look at Microsoft. Okay, so right here in the 2-hour chart here, we have a rally, a base, and a drop there. Um, right in there we have that area of consolidation here. Like pop up the 2-hour here for a second here. So right there, there's our supply zone here. Okay, price can notice now right there we have that bearish candle there. Notice that little consolidation candle right next to it, and then there's that gap, and then there's that drop there. Again, there's the sudden exhaustion of buyers that I referred to before, and so this would be an area again where we could express a bearish trade out of. Whoops. Let me just fix that for a second. We would express a bearish trade out of that supply zone there. So that would be again where we would express a bearish trade. So that's about 3.5% from where we are now. Okay. On the in terms of what's below here, this is technically this is an area of demand here. There's a drop, a base, and a rally there. Okay. But having said that, because of all of this other trading that went on here, all of this might just be a reaction to all of this. So I don't really see any. This is not a quality zone at all here because of the fact that all of this, there may not be any residual demand in here. So I would actually be wouldn't be looking to trade here, and I would not be looking to trade here. Again, this is an area of tested demand here. There was a drop, a base, and a rally. Price came back, it reacted, it came out of here. So again, this is all tested. Okay, and similarly right here. Okay, this is a multi-tested area of demand here as well. Okay, and we can also think of that, of course, at this point as support. Okay, so again, there's really nothing that I see that kind of gets me excited in terms of a buy point on Microsoft here. Obviously, if one drops it down to a 5 or a 15-minute chart, yeah, you could probably find some kind of intraday kind of scalping levels in here. But I'm more or less focusing here on kind of those intermediate time frames of the kind of the 2-hour and the 1-day, particularly because those lend themselves much better for options trading. So that's the story with Microsoft. And lastly, we'll finish off taking a look at Tesla and Google. Okay, so Tesla knocked it out of the park a couple of days ago with their earnings announcement. So right here was our earnings gap here. So in terms of trading levels now, there's really nothing below here until we get some trading in here. Right in here, if in fact this thing goes further, if we drop this thing down to a 1 or 2-hour chart, there's probably something sitting in here. You can see that there are overlapping bodies here. So within here there is a story. So we would need to see this thing kind of go further, and then we would then kind of do our investigation and see there might be a level in there, and that's sitting in around the 260 mark. But at this point, I wouldn't be looking for anything in terms of any sort of buy point. Okay, right? Really, there's nothing clean or really useful until right here at the 200 level. And needless to say, that's a long distance. And frankly, we don't want to see that because it probably means that the market has fallen apart at that point. So I don't think we want to see that. On the other hand, there is a supply zone here that goes back to July of 23. So if we go right back here, okay, right here we have that rally base drop formation. It shows up a little clearer in the 2-hour chart. And I've noticed there's that gap there, and then the very, very bearish candle as well. So right here, there's that clear exhaustion of buyers here. And so what we could do, of course, is again express a bearish trade out of that. So that's about that's about 7.5% above where we are now. So that's the story with Tesla. And lastly, we'll wrap this up by talking about Google, or I should say Alphabet. Um, so at any rate, here we are. Here is Alphabet here. Uh, Over here we have a rally-based drop formation. Okay, so notice right here now we're kind of in we're in the neighborhood here. So we're about 3% away from that. That's sitting at around 172, and that right now is sitting at 167. So this thing has got to go up about $5, which is about 3%, and this would be the place where we would express a bearish trade. Okay, and if you notice here, I also have a couple of this is our back line. Okay, and that's kind of where the candle that trades the highest goes. Okay, and then right here, one could choose different levels of aggression to get into the trade. So one potential front line is here at a 173.15, and then this is at 172. So obviously one could be more patient and look for it to go up further, and one, of course, would then get a better price. On the other hand, you might just miss the trade, okay? Because right in here, this would be this region right here. This would be the difference between getting into the trade and not getting into the trade. If you were looking to get in at 173.15, if it doesn't make it there, you're not getting in the trade. So you have to make your decision there. So at any rate, that supply zone there is sitting roughly at about 3 to 3.5 or 4% up, depending on which front line you use. And then down here, particularly if we look in the 2-hour chart here, we could see that they're roughly about 5% down. This is where we could express a bullish trade from here. So at any rate, that's what I got. Hope you found this useful. This is Mitch Firestone with Precision Trading Labs, and I will see you next time. Take care. Bye-bye.